Hello and welcome again. This is Robert Schein, Managing Director and Partner at Blanke, Schein Wealth Management. Today is February 16th, Tuesday of 2021. We're going to get into our daily updates as to what the markets are paying attention to. So we are too at Blanke, Schein Wealth Management. Thanks for watching. On the heels of my Friday edition of Friday Insights, I talked about inflation. If we're looking at the overall playbook that's playing out right now, right? The Federal Reserve is focused solely and intently on reinflating this economy, right? To ensure that not only there's a backstop, but also that unemployment is well on its way in terms of getting the U.S. worker back to full employment. Therefore, they're going to keep interest rates artificially low for longer. Those are their words, not mine. What happens is you see an inflation sort of trade playing out. So anything from the commodities trade that we're seeing to, as I talked about this, last week, oil and lumber, those are up at all-time highs. Copper, all-time highs. That's sort of your reinflation indication that that's exactly what's happening. Also, we're seeing real estate all-time highs from a residential real estate side in some subsections across the United States, as well as the stock market. Dow, NASDAQ, and the S&P continue to hit all-time highs. Why is that? Is because when the Federal Reserve is intent on one thing, which is making money cheap, liquid, and don't forget that Congress is also handing out additional stimulus, not only what they did last year, but more to come. And in fact, this Congress is probably going to gear up to even more than we've ever seen before, spending money. Now, obviously, that will have to be addressed and dealt with in years to come. But as of right now, what the market's paying attention to is today and 6 to 12 months into the future. And what it's really saying is that we're going to see consumer discretionary do quite well. We're going to see travel, leisure, and everything else. The economy is going to reopen. And it's really predicting that. You can see that on some of the different equities and some sectors of the economy that we're seeing right now. But why is this happening? Well, number one is the vaccine. The vaccine rollout is accelerating, right? They were trying to get up to 500,000 doses a day and 1 million, and now they're at 1.6 million. All the while, in terms of vaccines a day for Americans that are lining up for them. That being said, you also have 3 days in a row this last weekend, the 100,000 mark, which was a huge mark across the reported cases of coronavirus in the United States. We're below that. In fact, it's by 53,000 yesterday, which is tremendous. Now, keep in mind, there's some weather-related non-testing going on, but the trend is our friend, right? Cases are coming down, so the virus is running its course, hopefully, as well as vaccines are now hitting and accelerating, and we're seeing more and more of that. So the markets are seeing all of this, putting this together and saying, again, markets are future indication and they're pricing sort of the future opportunities for business going forward. They're seeing a reopening trade even bigger than what we might have anticipated. Therefore, the S&P 500, a lot of the consensus is $173 for the S&P right now in earnings, which is about a 22.5 on a forward PE. It's increased. Even Goldman Sachs took it up to 181 over the weekend this weekend in terms of revising their forward forecast for earnings per share in the S&P 500. You're going to see other Wall Street firms follow suit as well. And finally, the string of record highs. Now, keep this in mind, right? The S&P 500 for the first 2 months, which has been positive out of the when we hit a new year, when the S&P is positive for the first 2 months, and that's where we're headed right now, especially with February. 10 record highs in 2021, and also when you have 10 record highs, so new highs to the start to the trading year that we've seen. Only 11 other times we've had that sequence of events since 1929. The S&P, when you've had that setup, the S&P 10 out of the 11 times for the previous years that have had the same setup that we're now experiencing right now, it's basically year to date so strong in the markets that when you've had it that before, you've had an average gain on the S&P for the remainder, the full year, if you will, of about a 16% from the 10 of the 11 previous data points that we look at in terms of the trading almanac. What that really translates into is that when you start a new year, on a positive note, and that trend is continuing to create new highs, right? 10 new highs to start 2021 in the first basically month and a half, 2 months of trading. The trend is your friend. Don't ever fight it, especially when you have the backdrop of the Federal Reserve. Now, all of this is going to also play out later on, and we're going to talk more about this, is the 10-year Treasury keep an eye on the 10-year Treasury. It's rising. The 10-year Treasury steepening in terms of the yield curve, the 2s to 10s. That's positive for banks and financials, and we're seeing those catch a bid. So again, another component of the market, as well as energy. Energy and oil is at an all-time sort of 12-month high right now, year over year. Therefore, energy is another component to the S&P rising. Again, that's one of the reasons why the market is rising in the S&P 500. So all of this is going to be really important to watch is the 10-year Treasury, because there's resistance on the 136, 137 level. I'll talk more about this on a future update, but essentially that's an upside in terms of where the 10-year Treasury is. Right now we're about 1.26% on a 10-year Treasury. So we're about a 10 basis points away from that resistance. And so we believe that the next 6 months, we're going to see the 10-year Treasury flirt with that resistance, and then we're going to see the battle play out, whether it will break through and break above the 136, 137 on a 10-year or stay below. And so we will find out where the markets will basically trade adversely or positively based upon that particular keynote. So keep that on your dashboard, the 10-year Treasury, as we go forward. That's going to give us an indication on sort of the future volatility that we will see. And that's when the volatility will come in, is when the 10-year Treasury is challenged at that key support level. So that's where we are. That's our update for today. Markets are up, and so they can continue to stay up if the trend continues like it has in the past. Again, markets don't ever repeat themselves, but they rhyme with history. That's why we pay attention to that. So that's our update for the day, and thanks for watching. Take care.